Hello, everyone. It's great to be here. I'm Julia Valentine. Marty was very, very kind to introduce me, and these are my favorite conferences to be at. And it's my pleasure to introduce Zach Ellison, who is the Managing General Partner and Chief Investment Officer at Applied Real Intelligence, LLC. And it's a venture debt fund. And Zach, let's start with you. Can you tell us a little bit about the fund? And actually, before Peter joins us, I'm not going to say tell us a little bit. I'm going to say this is it. Just go. Take all the time you need.
Great. And can you hear me okay now?
Yeah.
Okay. Sorry, there's just two mics. Can we get rid of this one? Thanks. All right. Hi, everybody. Hi, everybody here and everybody listening. My name is Zach Ellison. So I run ARI, Applied Real Intelligence, which is a management company that has launched ARI. Great. Has launched ARI's Venture Debt Opportunities Fund. And so really I'm here today to talk about venture debt and the huge opportunity set in the market right now in the space. And so just before we get into it, I'll give you a little bit about my background. So I spent about 20 years in the markets. In fixed income. I've been at 3 different trillion-dollar firms. I started out, actually 4 maybe. So I started out at Scotiabank underwriting leverage loans in media and telecom and technology, pre-financial crisis, through the financial crisis. Helped to run about $6 billion there. Went back to University of Chicago for my MBA in analytic finance, came out and was a bond trader at 60 Wall Street at Deutsche Bank when we were #1 in the world, biggest bank, #1 in fixed income. Did that for a couple of years, then went to the buy side to a company called Sun Life, which manages about 1.4 trillion, helped run a $25 billion portfolio there. So long story short, I've been in banking, I've been in trading, I've been in portfolio management, and I saw this huge, huge opportunity about 5 years ago, well before the rest of the market, and that was within venture debt. And so what venture debt is it's essentially loans to the best venture capital-backed startups in the country. And ultimately, this has really taken off recently because we saw the collapse of Silicon Valley Bank, which was the biggest lender in the space. And so what's been created is a big supply and demand imbalance. There's essentially a huge demand for capital right now from startups. They're having a lot of trouble raising money in the equity markets. I think anybody who follows startups or the venture ecosystem sees what's going on. Valuations are down immensely, so therefore the cost of capital is up immensely for startups on the equity side. It's very hard to raise money in size right now. It's very hard to raise money quickly. And the terms are not attractive to founders. And almost every deal that's getting done now would be at a lower valuation than in the last couple of years when we were at this market peak. So that would, when you do a round at a lower valuation, it's called a down round. And this is basically what every startup wants to stay away from because it's a negative signal to the market. So you've got thousands of startups that have raised roughly 750 billion in capital, equity capital, the last 3 years that are going to need to come back to market and raise more money to keep growing. And they have 2 ways to do that. Equity financing, which is very tough, like we just went over, or debt financing. Now, when you look at the debt side, this is the part of the market that's experiencing a tremendous growth. You've basically got a product where there's this immense demand, but on the supply side, Silicon Valley Bank collapsing for unrelated reasons, mainly related to their lack of interest rate hedging around their government bond securities. They've been pulled out of the market largely, and other regional banks have stepped back as well. So you've basically got this lack of capital from the banks, and meanwhile, there's not that many non-bank venture lenders, and those that are in the market on the non-bank side are licking their chops. And this is very similar to post GFC in 2000, call it 2010 through 2015. When private credit had absolutely phenomenal returns. If you look at all the firms that are doing really well now in the private credit space, they really made their run following the GFC. And that's the type of opportunity we have now within this venture lending market. You basically got the banks pulling back. It's the exact same thing. It's very analogous to what we saw, just on a smaller scale, but with a lot higher return potential, because typically venture loans are yielding on a cash basis 15 to 20% in this market. They're all floating rate, they're monthly pay loans, and they're short maturity. So think about 2 to 4 year loans with a prime rate plus a credit spread of 8% roughly. So you're talking 16% cash as the only lender in the capital structure, senior security, a lien on all their assets, LTVs in the 10 to 15% range. I mean, it's almost like too good to be true, but it's not. I mean, this is why I left 3 of the world's leaders to start this firm, because I saw this opportunity coming. And it's just really taken off recently, not only because of SVB collapsing, but also now we're finally getting what I call the institutional stamp of approval. BlackRock last week, or maybe it's the week before last, excuse me, bought one of the biggest venture lenders in Europe called Kreos, Kreos. And if you read their press release and read between the lines, it basically tells you what their thesis is, which is this is an area of credit that offers differentiated access and higher risk-adjusted returns, and their clients want this. So when you've got a $9 trillion asset manager coming in saying, we just bought one of the biggest venture lenders in Europe, that basically puts a stamp of approval on it. The last thing I'll mention along those lines is some of the other smartest, largest investors in the world have been getting into the space, but people haven't really noticed unless you're in the space. Blackstone, they announced middle of last summer that they are putting $2 billion of capital to work in technology and venture loans of their own capital. So you guys can't access it yet, but you know that the smart money's doing it. Oaktree, one of the biggest LPs in the space as an investor in other venture lenders. KKR and Wellington, both trying to build or buy, but haven't done so yet. So you've basically got the smartest money in the world saying, hey, we see finally where the puck's going. We're going to skate to where the puck's going, not necessarily where it is today. And so it's been great for us, because we were, probably too early. I was probably like 3 or 4 years ahead of the market on this. And so finally the market's catching up with where we're at. So I'll leave it at that for now, Julia.
Zach, we have a question from the audience, and I was going to bring up expected returns anyway. So why don't I'll read out the question to you. Hercules Capital, which is publicly traded, that's venture debt plus. How are you performing versus them? Obviously, with them, I have 100% control, liquidity, etc. So let's keep it as an open-ended question. How does a private vehicle compare to a publicly traded venture debt fund? And maybe also talk about the expected returns on your side.
Sure. So let's start with the expected returns, and then we'll talk about public versus private.
Sure. Yeah.
So what's great about Hercules and other publicly traded business development companies known as BDCs is that they have to disclose all the loans they've made in their quarterly and annual filings. So I've actually gone back with our team, and we've looked at every single deal Hercules has ever done in its history. We've also looked at every single deal any BDC has done that specializes in venture debt. So we've got a database of over 5,000 deals pulled right out of SEC filings that shows that the average yield on these loans going back to 2005 is roughly 15% per year with very, very low dispersion. So we're talking 14 to 15% yield, not including equity participation, which we'll get into, on an annual basis. And there's never been a year in the history of venture debt where there's been drawdowns. So in 2009, there was some loans that got written off, but in aggregate, the strategy was still producing attractive returns. The one thing I didn't mention, which is actually key to the strategy, is that along with the loans, the lender receives equity warrants, i.e. the ability to buy stock in these companies that they're lending to. And that equity participation historically has been a nice sweetener, but in this market, that equity upside is worth substantially more because valuations are lower. So you're basically buying in at a lower price, and you're also able to get bigger equity packages as a lender because borrowers are more more desperate to raise capital. So they're much more lenient in the amount of equity they give you. So to answer your question, Julie, about returns, we know factually looking at almost 20 years of public data that anybody here can pull up for themselves, that you're getting about 15% debt yield, and then you're getting another, you call it 3 to 5% historically from the equity participation. So call it roughly about a 18, 20% return, very low vol, no years of drawdowns, very low correlation to the public markets. And so actually, if you look at things on a risk-adjusted basis, venture debt has actually been the top performing alternative asset in the world, actually, over the last 20 years, because it's got low correlation, low vol, no years of drawdowns, and roughly 20% return. So that's why venture debt's attractive from a return perspective. Now, in terms of the type of vehicle you want to be in, there's really two ways to access venture debt relatively cleanly. One is by buying the stock of these BDCs that specialize in venture loans. So there's 5 BDCs that do this. The biggest and longest running is Hercules, and they tend to be the leader in the space. But there's others as well. TriplePoint is another that's been public, I think, since 2015. Runway Capital, Trinity, and Horizon Technology Finance, which got bought by Monroe Capital earlier this year. So you've got 5 publicly traded BDCs. So if you like venture debt, you can go buy it on your phone right now. Now, here's the problem with that. The problem is that publicly traded stocks, especially BDCs, have a lot of market beta. So if you're thinking about your risk-adjusted returns, you have to know that the stock is not necessarily going to trade in line with the value of the underlying assets. It's going to trade in line with the broader market. And I can give you a perfect example of this. So if you go back to 2020, when COVID first began, and we were all freaked out and didn't know we were going to wind up heading into this irrationally exuberant 2021 period, what happened? The market sold off in March and April of 2020. Because BDCs have a beta that's closer to 2 than it is to 1. In other words, when the market's down, when the market was down 40%, some of these BDCs were down like 60, 70%. But the underlying value of their loans actually never got hit. So if you were an investor in Hercules at that time, you can look up the exact number, but I think their stock was down somewhere around 70%. So imagine you're an investor and you put $100 million into Hercules, or any of these public BDCs because you love venture debt. You get hit with COVID, which nobody saw coming, and all of a sudden your 100 million is worth 30 million. Well, guess what? You're looking for a job. You are. Like if you're an institutional allocator or you're a family office, CIO or director of alternative investments that pitch that, you are absolutely looking for a job. Now, if you were involved in venture debt on the private side at that point, you'd look like a genius because the underlying loans never got hit. Therefore, none of these loans were actually marked down. So the value of your book wouldn't have changed in March or April because all the loans were continuing to pay off and they're all floating rate. So rising rates don't actually hurt the value of the loans. They're called par loans for a reason, meaning when rates go up, they still trade at par. Like when I was at Deutsche Bank, we had a par loan trading desk that sat right next to my trading desk. And all the loans are always trading around like 99.5 and a little bit over par, right? And so there's a lot of risk in the structure that you choose more so than the underlying product. The loans that Hercules makes are not really that differentiated from the loans that the other BDCs make or that some of the private funds make. And you can see because they're competing for the same deals. It's literally the same pool of assets in many cases. So I always advise people, if you just want liquidity, of course, buy the BDC. But do you want to sell when you're down 70%? I mean, how much is that liquidity really worth? Or would you be better served locked up in a vehicle that actually produced a positive return during that year of roughly 20%? So imagine the difference in performance. If you had sold at the lows, if you owned the BDC, you're down 70%. If you just held your position in that same basket of loans, you would have been up 20%. You're talking a spread of 90%, 90 points. It's phenomenal. So that's why that's why we're structured as a private fund. The other big advantage of being a private fund is that you can do things that public entities can't. like offer co-investing opportunities and offer your LPs all types of informational flow. So we're seeing tons and tons of deals. The deals that we don't necessarily like for our fund might still be a good deal or a good company, and we can share those opportunities with our LPs. So family offices actually love our structure, and one of the things that they love about it is that we offer this informational flow that they can't get anywhere else. Mm-hmm. But we also offer co-investing opportunities. So if you're an LP in the fund, you can invest alongside us in certain deals that you like, but you're not forced to. And you can get those investments at a very low fee or no fee in some cases. And so that's ultimately why I think in general, if you're a direct investor, if you're a family office, I would not recommend owning any of the public structures. I would look for private structures that offer co-investing opportunities, and think of it as, you know, relatively long-term investment, but one where you're getting paid to wait. So you're basically investing in these VC-backed companies that you wish you could have had access to as an equity investor, but you weren't shown that deal because these deals get snapped up early. So you come in at a slightly later stage as a credit investor in those same companies, and then get paid 16% per year with your equity kickers on the back end. Much better than being locked up in, you know, a 10 or 12-year equity investment where you're getting no cash flow and have a big J curve, in my view.
Yeah, Zach, talk to us a little bit about the deals, LTV.
I just want to let you know that Peter Plautz at the Family Emergencies Award.
Okay.
So you got the next 20 minutes to yourself.
Great. Everybody here is going to be an expert in venture debt. You guys are going to make so much money. It's good, crazy. It doesn't need to be with me. You're just going to know more than the rest of the market.
Zach, talk to us a little bit about how you actually, you know, what's your deal sourcing and due diligence process, and also, you know, what are your favorite deals, LTV, anything that you want to talk about?
Sure. So, and just to be clear, we're on Fund 1. So we are still raising money and actively looking to deploy a bunch of it. We've got some money closed. I just put that out there. So if you are interested, there, you know, come talk to me about that. Let me talk to you about underwriting, because ultimately everybody understands the upside, but I think where people go wrong is they think there's risk here that actually isn't there. Because people hear the word venture and the first thing they think about is, oh, aren't like 9 out of 10 startups going to be failures? And the answer is, yeah, if you measure them from day one, when it's, you know, 2 people and a laptop and a puppy dog in a garage, like, yeah, most of those companies are going to fail. I always think of it as, think of this analogy. You go to the horse track and you are betting on horses, okay? Equity investors are basically betting on horses they've never seen run. They look at a jockey, they look at a horse's ass, literally, and they'll say, okay, let's just bet on those 5 horses. They look, you know, they look good and the jockeys look light. They can probably run. We don't know which one will win, but maybe one of the 5 will you know, finish in the top 3. That's equity investing. They don't really have, you know, they have no knowledge of how these companies are going to fare. As a debt investor, we're coming in at a much later stage, typically like a Series B or Series C round would be the first time these companies access venture debt. So that means they've already done a friends and family round, an angel round, a pre-seed round, a seed round, a Series A, a Series B, a Series C. They've done like 5 to 7 equity raises already. They're generating revenue. They're knocking out 10, 20, 30 million a year in revenue at a minimum. That's when the lenders come in. So we are basically going to that same horse race and we're saying, we've already seen 80% of the race. We're looking at all these horses. We've seen them run. We've seen the ones that fell off, the ones that are at the back of the pack. We're not going to bet on them. We're going to bet on who we think will win, place, and show at the 80% mark. And so that's the way to think about this. It's not high risk because you hear the word venture. It's actually lower risk because these are the best venture-backed companies. It's not a small business loan. These are companies backed by, you know, Andreessen Horowitz and, you know, Kleiner Perkins and, you know, Sequoia and, you know, the next 500 best VCs in the country. So we're basically betting on the winners. We're saying we think they've already proven that they're going to have a high probability of success, and we're just going to give them some more growth capital so they can run a little bit faster, get to their milestones a little bit quicker, ultimately have a higher valuation. And the founders really like it because what's in it for them? Cheaper than equity, less dilutive. If you're a good business, why would you sell equity in your business? Like that's like rule number one they teach you. If you've got a good business, why the heck would you sell it? Right? You're going to lever it. I mean, that's how people make money. A question.
Now, how has your business changed with the Silicon Valley Bank?
Yep.
Kind of going down?
So, question was how's the business changed with Silicon Valley Bank going down? It's been a bonanza. It's been the best thing that could have ever happened for non-bank lenders, because what it's done is it's taken the biggest competitor in the market that would supply cheap capital to anybody, essentially, and it's put them on the sideline. So it's like any market. If you ask the best investors, what do you really look for fundamentally? There's two things they're always going to tell you. One is they all think about diversification. And the other is they look for opportunities where there's a supply and demand imbalance. It's as simple as that. There's more money chasing an opportunity than there is available capacity. Mm-hmm. That's what drives prices up. So what we have right now is this opportunity where there's a ton of capital, a ton of demand for capital from these startups, more so than ever before in history. And yet the supply of capital has now all been pulled back. It's like another analogy I use is say you go to a party and you show up and you show up late and there's like no food there because all the pizzas have been eaten. Like that's kind of what it feels like right now, right? Like in 2021, you'd go and there'd be 10 pizzas for everybody to bring home. And they'd say like, hey, do you have enough room in your car because you got to bring these pizzas back with you? Well, now you go and there's nothing left. And so founders are lining up, and guess what? They're lining up against all their other founders. And so there's tons and tons of demand, and there's just not enough supply. So it's really simple economics. And I could give you all the details, but it's as simple as that. Demand far outpaces supply. Another question?
Talk a little bit about the loans and how you structure them. Are they
Yep.
loans?
Yep. And this goes back to Julia's point. So the question was, how do we structure the loans, which will also lead into how we de-risk them. And this is not unique to what ARI is doing, although we do have what we think is the best underwriting process in the business based on 40 years of doing 50 billion in transactions. But here's how you do it. So most of these loans on average are going to be about 3 years. So 3-year maturity. They're floating rate, like I said before, typically prime rate plus a credit spread. And then you're getting warrants, and the warrant coverage is increasing in this market, but on average, let's say it's 10% of the value of the debt. So you make a $10 million loan, you get $1 million worth of warrants. Right? So $1 million worth of equity exposure. The interest is paid typically every month, which is nice. And most of these loans have what's called an interest-only period for like the first year. And this is all negotiable, right? So some people might say, oh, we do 18-month IO period. Some people might say 6 months. Just talking, generally speaking. So you got a 3-year loan, 1-year IO period. Then it's 2 years of straight line amortization, meaning in month 13 through month 36, in this case, you're getting your principal paid back in equal installments every month. So what's nice about that is as a lender, you're not left with this big balloon payment at the end, which would be risky. You're getting paid down very quickly. So think of these as very short duration loans, short maturity loans, and technically with no duration, no interest rate risk because they're floating rate and they pay every month. So that's kind of the starting point. Then you've got these equity kickers. The warrants are typically 10-year warrants. The strike price is negotiable, i.e. the price that you pay to exercise the warrant is negotiable. In this market, as a lender, you can get much lower strike prices. I mean, you can buy that equity for cheaper. And in fact, some of the deals we're looking at now are penny strikes, because as a lender, we can say, well, if you want the loan, you're giving us the equity and you're going to give it to us with a penny strike, or you can go elsewhere. But guess what? There is no elsewhere. It's like literally walk out in the desert. I mean, that's kind of the option. So that's the starting point. Now, in terms of how these loans are structured and de-risked, the key metric that everybody looks at is enterprise value. So some people will even call venture lending enterprise value lending. So what that means is, what is the company worth? not based on the VC's valuation, because that doesn't mean anything. What do we think it's worth in real terms based on the revenue numbers that they're generating? So you take that valuation, let's say a company's worth $100 million. Most lenders are trying to keep their loan to enterprise value metric, or LTV, less than 20%. In this market, being that everyone's more conservative and we can be a lot more selective, most of the LTVs are closer to 10%. So take a $100 million company, let's say it's doing 20 million in revenue. You value it at 5 times revenue because it's sticky revenue and it's got a lot of growth. $100 million enterprise value, you make it a $10 million loan. And then you get $1 million of warrants with a low strike. That's kind of the starting point. The other thing that we will look at very closely is their revenue profile. Keep in mind that most of these companies are not profitable. In other words, they do not have positive net income because they're generating top line revenue, but they're growing really fast and they're investing in their growth. So they're spending money to grow. That doesn't mean they can't pull some levers and become profitable, relatively quickly. It just means that most companies that are early stage that are VC backed are trying to really scale as quickly as possible. So think of venture debt as kind of filling that gap between revenue and their cash burn that's accelerating the growth. So in terms of the revenue, we want to keep our loan to revenue less than 50%. So in other words, this company in this example is doing 20 million a year in recurring revenue, contractual, sticky revenue. We would lend them up to $10 million against that 20 million in revenue. Okay, so you've got starting point is the enterprise value. Keep that LTV around 10%. Next thing we're looking at is revenue. Keep the loan to revenue less than 50%. Then we're also looking at the cash they have on hand that they've raised by selling equity. So think of venture debt as a complement to equity. It doesn't really replace it, or if it does, it's only really replacing it on the margin. So another good example I would use is, say a company wanted to raise, say a company worth $200 million and they want to raise $40 million. So they're going to sell 20% of their company to raise $40 million at a $200 million valuation. They might do 30 in equity and 10 in debt. Right, so that way it reduces their cost of capital because the debt's a lot cheaper than equity. It also reduces their dilution, so they keep that extra roughly $10 million worth of equity that they would have sold. Now they keep that and replace it with the debt. So the cash metric, a lot of folks don't look at this as closely as we do, but we want to keep our loan to cash less than 33%. So if the company has done like a $30 million equity raise, we'd want to keep our loan to $10 million or smaller. So if you think about it holistically, you've got enterprise value de-risking you. Company could fall 80, 90% in value and your loan's still unimpaired. You've got the revenue de-risking you because it's double the loan amount. Plus, these are companies that are typically growing at 50% plus annualized, even at the low end. So you've got, not only are you lending against this revenue, but these are not declining businesses. You're not lending to some business that's distressed, that needs like a loan to survive. You're lending to companies that are growing at 50%, and they're saying, hey, with your capital, maybe we could grow at 70 or 80% annualized because we can really supercharge this and build out our tech stack, our marketing, our distribution more quickly. And additionally, it's very important to understand the equity sponsors that are already investors in the company. What's their thesis on the company? How much capital have they committed? How much skin do they have in the game? How likely are they to stick with this company if it doesn't perform as well as expectations? Because what you see with VCs is, they just keep betting on the winners, and the ones that aren't going to be big winners, they basically abandon. And that's kind of like, nobody wants to talk about that, but that's the reality. So you want to, as a lender, you want to understand that the equity sponsors that have backed this firm are going to be there supporting them to some degree, even if the company doesn't live up to all the hype. You want to partner with equity sponsors that you trust and that have like worked constructively with lenders in the past. So ultimately, when you add all these things up, another thing I should mention too is deal structures. The way these deals are structured is they always have, well, at least the way we do it, they'll always have covenants. So the good deal structures will have at least 2 covenants. There's going to be what's called a performance to plan covenant, which is typically like a revenue number, saying, okay, your budget calls for X amount of revenue growth. And if you don't hit that, or if you miss it by a certain amount, I should say, then that'll trip the covenant. There's also a minimum liquidity covenant, which can be tied to the number of months of runway or a certain amount of cash on the balance sheet. Right. So those are probably the 2 most common covenants that are in most strong deals. But there's a whole bunch of other ways to structure these deals to keep them very low risk. And one is having what's called a delayed draw facility, meaning I might commit to making a $10 million loan, but I only advance you $5 million of the cash on day 1. And to unlock the remainder of that $5 million in cash, you would actually have to hit milestones that you've stated that you can achieve. So that way, it's kind of like, it's the whole like trust but verify kind of thing. Yeah, like I trust that you can get there, but guess what? You're not getting our money until you prove it. And if you structure the deals right, and you're underwriting a very good underlying business, that's kind of where the magic happens, right? Because you not only have this really strong underlying business, but then you've got really strong sponsors on the equity side, and you've got great protections in place with the margins of safety in terms of enterprise value, revenue, cash. We also look closely at liquidation value. What is this company going to be worth if you had to sell it for scraps in a down market? And you combine all those things, and then you put a really good deal structure around that as well, where you're the only debt in the capital structure, you've got covenants, you're basically going to take the keys to that company if you don't get your money back. And you don't want that to happen, of course, and that's a last resort. But the reality is, given that you're buying into these companies at such a low LTV or lending to them at such a low LTV, if you did happen to own it at that price, that's a huge win. Marty?
So, last question. So can you give us a ballpark, like how big is the market?
Yeah.
I mean, I know that we got another law firm and they said that it was like 30% lending on if you raised $20 million, they would lend on 30% of that 20 million. How just ballpark, how big is the market and how much of the market is controlled by the BDCs and how much market is controlled by guys like you?
Yeah, so it's a great question. So the market for venture lending in the US, which is what we focus on, was only about $5 or $6 billion 10 years ago annually. So that was how much capital was being deployed. And most of that was Silicon Valley Bank and Hercules, and then a couple other smaller lenders. But the majority was SVB. Today, in the last 3 years, the annual numbers are a little bit over 30 billion. So it's basically grown 6x in the last decade or so. These are numbers coming from PitchBook, pretty reliable source. Not perfect, but solid. They're all private loans, right? So you can never really get the exact size of the market, but I think it's a pretty fair estimate. So think of historically as venture debt being around 10% of the value of the equity that's deployed each year. And that's been fairly consistent over the last 10 or 15 years. So somewhere between like 8 and 12%, depending on the year.
What's the value of the equity deployed?
Yeah, so another great question. So Marty asked, what's the value of the equity that's been deployed over the last couple of years? So 2020 was 160 billion, roughly, and in equity that was deployed by VCs into U.S. startups, and that was an all-time record. That was already like multiples of previous records. And then 2021, it went bananas. We went to about 345 billion. So imagine like somebody hit 70 home runs, and the next year somebody came along and hit 140. That's kind of what happened in the VC ecosystem. So you went from 160 in 2020, 160 billion capital deployed, to 345-ish. And then last year, I think was about 240. So down a lot from 2021, but still 50% greater than the record previous to that, which was 160. So you add those up and you get roughly 750 billion in equity capital that's been deployed to US startups in 3 years. And on the debt side, it's been a little over 30 billion each of those last 3 years. So it's like 32 to 34 each year. So call it 100 billion. So you've had 850 billion capital deployed between 2020 and year end 2022. Now, and here's where everything kind of ties together. Startups need access to external funding to keep growing. And so they typically are coming to market, whether it's for equity or debt, every 2 to 3 years. That's the cycle. So all the folks that raised money in 2020 and 21 are coming back to market later this year and next year. Folks that raised money in 21 and 22 are going to be coming back to market in 2025. So there's going to just be an immense amount of demand for capital in 2024 and 25, but that's also being met with this pullback from bank lending. And to answer Marty's question about what percentage is bank lending versus non-bank lending, it's hard to say exactly, again, because all these loans are private and the banks don't necessarily break out what's a venture loan versus what's just a traditional corporate loan. But I would estimate that with the pullback in funding from SVB and other regional banks as well, so Signature Bank was a venture lender. They're not going to be active anymore. First Republic was not a venture lender. They do a lot of support of VCs and whatnot, but they don't actually make venture loans. But there's other regional banks as well that have all kind of like dialed back because they're getting hurt on their commercial real estate portfolio. They're getting hurt in their government bond portfolio. So they're just much more risk averse and less inclined to deploy capital. All that said, I would estimate that the amount of available capital from lenders is down about 50% from where it was at this time last year. Yeah, at least, yeah.
Mm-hmm.
So even though Silicon Valley Bank was about 80% of the market, it's only down 50%?
Well,
Bridge properties taken up.
yeah, so Marty, a couple things have happened. One is that other banks are trying to take SVB's market share. So think of SVB's market share as being, I think they're about roughly half the market when they went down, because a lot of it had already kind of been distributed. But now that market share is being largely redistributed to other bank lenders. So you've got like banks like HSBC, Stifel, JP Morgan. They're all hiring ex-Silicon Valley bankers. And all this is like public. I mean, not all of it, but you can read the news and see how many and who's been hired where. And SVB is still under First Citizens technically in the market, and they'll pound the table and tell you that they're doing business, and they are to some degree, because they've got this giant portfolio and they need to do something with it, and they at a minimum need to service it. And they of course want to try to keep some of those clients, but the reality is that business is going to be a much smaller business 3 years from now than when it was at its peak, and that's inevitable because the model's changed. The SVB, of course, has lost a lot of credibility in terms of its brand. They're now owned by a regional bank in North Carolina. That's not the same as what they were before. And also with this kind of splitting of the deposit business being solely with the lender, that'll hurt as well. Now a lot of startups want to keep their deposits broadly distributed, which means as the lender, as a bank lender, it's a riskier proposition if you don't. Yeah, it's less desirable. So bottom line is there's a whole bunch of reasons why banks are pulling back. Another is going to be the re-regulation of regional banks in general, because they seem to not be able to govern themselves effectively. They're dropping like flies. So there's re-regulation coming. I think venture debt is not really a good bank product because it's to early stage companies that don't have long-term track records, don't necessarily have a lot of hard assets. So even though it's a great lending product for private lenders, as a bank underwriter, it's not really where you want to be. You want to be underwriting big deals with 20-year operating history and a ton of hard assets.
What percentage of loans do you model as
losses.
So this is the last question. The question is, what is the percentage of loans that are being modeled?
So great question from Stephen. So the question was about loan losses. And so historically, the loss rates in venture have been less than 50 basis points per year. That's conservative. I think they're actually closer to about 25 basis points per year. Now, a lot of people would argue in a convincing fashion that venture debt wasn't really around 20 years ago. So what do we care about their record during a bull market, right? I mean, and I agree with that assessment. Like, I don't care how anybody did in the last 13 years because everybody made money. So someone's like, here's my 10-year track record. I'm like, great. Like, what does that mean? It means zero. All I care about is what was your track record when shit hit the fan? Show me your track record from the GFC, and then we can talk. And if you show me your track record, in the last 10 years, I literally don't care. It means zero. So what's great about venture debt is we can look at how it did during the financial crisis because we have stats from Silicon Valley Bank and Hercules, which were making the majority of venture loans during that time. So not only were they underwriting the good loans, they were probably underwriting a lot of the mediocre loans as well, because they were the market, literally. So key takeaway, in 2009, SVB's net loan charge-offs, 2.6% of their book. So that means 97.4% of their book was making money, which means that product, their loans, made money on a net basis in 2009. Similar stats for Hercules, but even better, meaning lower risk, lower losses. And the key takeaway from Hercules numbers, which I love to point out, is that they've deployed almost 16 billion in capital in venture debt since 2005. And their annualized loss rates, going back roughly 18 years, are less than 10 basis points per year. Okay, so to me, that's mind-boggling. People say, "Oh, that's unbelievable. That's a lower loss rate than high yield, but much higher returns." It's almost equivalent to investment grade bonds, but 4 times or 5 times the returns. Like, how is that possible? And it's possible because it's a niche market that's inefficient. In other words, you think about risk and return on the efficient frontier, like I was taught at Chicago Booth or in the CFA program. That works if the product's in an efficient market. But if you're taking a product that's private markets, where there's asymmetric information, highly fragmented, some people know what others don't, most people aren't playing in the space, that's where there's alpha opportunities. And that's why I got into this. Like, I looked at every single private credit strategy there was in the market 5 years ago, and I said, where do I want to spend the next 25 years of my career? I'm not doing this because somebody's paying me to do this. I'm doing this because I think this is the place to be in credit.
One more question.
Very interesting thing, and maybe it's intuitive, but venture fund community, various reasons, cannot make these loans. Funds don't allow it, and the regulatory exemptions don't permit it for the most part. So
Right, you don't sit on the boards of any of these companies, right? You're a lender to them, and the VCs typically have a board seat or something like that. I mean, there's actually all kinds of constraints around that Matt Ming just brought up. So
as a lender, you will typically have board observer rights. So you will know exactly what the board's talking about and essentially have all that information, but you won't actually be on the board. But it's almost just as good because you're getting information flow in real time, and that brings up this point about monitoring, and the ability to monitor these loans is much greater than you'd get in the public markets because you're getting monthly financials, you're a board observer, and you've got not only monthly financials, but covenants, right? And so you're looking at these companies on a real-time basis, and if they start to deteriorate, you're going to see that before the market does. So this is not like, hey, I'm finding out 6 months after the fact that my public company had a terrible quarter. This is, I'm seeing in real time before anybody else where the cracks are, and I can go fix those if there are issues. And that's huge.
Zach, great job. Thank you so much.
Yeah, thanks for having me.